Frank, a 72-year-old retired machinist, moved $155,000 into a 4% CD. Instead of earning safely, he got a tax bill for $1,400. After years of owing zero, the reason is a 40-year-old IRS rule that can turn $1 of savings interest into 85 cents of taxable Social Security. Here is how to avoid it. This is the trap hiding inside America's retirement system. The IRS uses something called combined income to decide whether your Social Security gets taxed. It counts half your benefits, your interest, and even tax-free municipal bonds. Cross a threshold frozen since 1983, and up to 85 cents of every benefit dollar becomes taxable. Frank never saw it coming. The rule that cost Frank $1,400 was never designed to hit someone like him. His $155,000 CD paid $6,200 in interest, money he thought was safe. But that one line item was enough to drag his Social Security into the tax net. When Congress first taxed Social Security in 1983, it set the income line at $25,000 for a single filer and $32,000 for a married couple. At the time, only about 1 in 10 retirees was expected to cross it. Then, in 1993, Washington added a second tier, above $34,000 for singles and $44,000 for couples. Up to 85% of benefits could become taxable. Those numbers were set once and never indexed. Inflation has raised wages and savings returns every year since, but the thresholds have not moved a single dollar. That frozen math is why half of Social Security recipients now pay taxes on their benefits instead of 1 in 10. And the calculation is more dangerous than most people realize. The IRS adds together your adjusted gross income, any tax-exempt interest, and half of your Social Security. If interest from a CD or even municipal bonds pushes that combined income over the line, it doesn't just tax the interest. It drags your Social Security into the taxable pile. One extra dollar of savings income can make up to 85 cents of benefits taxable. In some income zones, that creates an effective marginal rate above 40%. A 4% CD can quickly become a 2.4% return after tax, and you won't see it on any bank statement. Frank's $1,400 bill was small compared to what many retirees face. But his real problem wasn't the amount. It was discovering that no one, not the bank, not the IRS, not his own accountant, had warned him. That silence is about to get more expensive in 2026. But there is a way out, and it starts with a line on a worksheet most retirees ignore. The problem is that line is different for every household, and getting it wrong can cost thousands. The worksheet the IRS uses is 3 lines. Line 1 is half your Social Security. Line 2 is every other income source, including savings interest. Line 3 is tax-exempt interest. Add those 3 numbers together, and you get your combined income. If that number crosses $25,000 as a single filer, the trap closes. Ruth found out the hard way. She kept $1,800 in CD interest on top of her Social Security. $1,800 sounds minor, but adding it to half her benefits pushed her combined income up by roughly $2,700. The IRS then counted nearly $2,700 of her Social Security as taxable. Her tax bill was $324. It wasn't the amount that bothered her. It was that she had paid zero the year before, and no one told her the rules had changed. The rules didn't change. Her savings did. Earl and Dot are married and thought they had plenty of room under the $32,000 line. Their CD interest totaled $6,200. That sounds safe until the formula does its work. Half their Social Security plus that interest created $11,470 of taxable income. Their bill came to $2,523. On paper, their CD was earning 4%. After the taxes hidden inside that worksheet, the real return was closer to 2.4%. The bank never showed them that number. But here is the part most retirees miss. The worst version of this trap can be triggered by money that is supposedly tax-free. Helen, a 75-year-old widow from Tucson, held $6,000 in municipal bond interest. She chose municipal bonds specifically because the interest is exempt from federal tax. But the IRS combined income formula includes tax-exempt interest. That's $6,000 of tax-free income counted against her Social Security and made part of her benefits taxable. Tax-free was not tax-free. It was tax-triggering. If those thresholds had been adjusted for inflation since 1983, the first line for a single filer would now be over $72,000, not $25,000. For married couples, it would be over $93,000, not $32,000. Washington chose to leave the numbers frozen. What started as a tax on high-income retirees is now a tax on machinists, widows, and anyone with a modest CD. And there is a second trap hiding inside the same worksheet. The IRS doesn't tax the interest alone. Every extra dollar of combined income can force up to 85 cents of Social Security onto your return. That means in certain income zones, $1 of interest can create 40 cents of tax. A 4% CD can turn into a 2.4% return before you even account for state tax. The worst part is that no institution is required to warn you. Banks advertise the 4% yield. Brokers advertise the bond income. The IRS sends the bill. None of them will sit down and explain the multiplier. By the time most retirees discover it, the tax year is over, and the opportunity to adjust is gone. But the system does leave you 3 moves that can stop the bleed before the next tax bill arrives. The first one takes less than 10 minutes and requires only last year's tax return and your latest account statements. The second one is a phone call to your bank that almost nobody makes. The third one can reclaim thousands with a single IRS form. Before those moves, though, there is one filing mistake that erases the threshold completely, and married couples make it every year. The filing mistake that erases the threshold completely is married filing separately while living together. Most couples assume filing separately will keep one spouse's Social Security out of the IRS calculation. The opposite happens. If you are married, filing separately, and you lived with your spouse at any time during the tax year, your combined income threshold drops from $32,000 to zero. That means even $200 of CD interest can make up to 85% of your Social Security taxable. The IRS doesn't advertise it. Tax software often buries it in the fine print. Couples make this choice every year, thinking they are protecting their benefits, and instead they hand the Treasury a bill they never needed to pay. But the filing mistake is only one part of the trap. Many retirees have heard that new laws ended Social Security taxes. The truth is messier. The senior bonus deduction gives taxpayers 65 and older up to $6,000 extra dollars off income, $12,000 for a married couple. That can help, but it is temporary, scheduled to expire after 2028, and it does not fix the frozen thresholds. The analysis is blunt. The deduction does not change Social Security tax law or permanently eliminate taxes on benefits. It works indirectly by reducing exposed income. So, a lot of savers are doing the right thing, moving money into high-yield CDs and municipal bonds, and still walking into a tax wall built 40 years ago. And here is where it gets even worse. Municipal bonds are marketed as tax-free, but in this formula, they count. Tax-exempt interest is added back to combined income. A retired teacher who puts $100,000 into municipal bonds to avoid federal tax can actually push her Social Security into the taxable pile. Helen's $6,000 did exactly that. She thought she was being smart. The system treated her as richer than she was. That's the quiet cruelty of the combined income formula. It pretends tax-free money is regular income, then taxes the benefit you earned over a lifetime. There is also a hidden cliff inside the 1983 thresholds. If they had been indexed for inflation, the basic line for a single filer would now be over $72,000, not $25,000. For married couples, it would be over $93,000, not $32,000. By leaving the numbers frozen, Congress didn't need to pass a new tax hike. Inflation did the work. Every cost of living adjustment, every renewed CD at a higher rate, every small pension increase pushes more people over the line automatically. That's why the share of retirees paying tax on Social Security has climbed from about 1 in 10 to roughly half. It's a slow-motion tax increase no one voted on. The final twist arrives when you see the real rate. A retiree in the upper combined income zone can face an effective marginal rate around 40%, not because the stated tax rate is 40, because one extra dollar of interest can trigger taxation on 85 cents of Social Security at the same time. The interest itself gets taxed and the benefit gets taxed. The result is like losing 40 cents of every extra dollar in that zone. A 4% CD can become a 2.4% return after federal tax. And for a few unlucky savers, adding state tax and the loss of a subsidy can push the real cost above the actual yield. The account grows on paper, while the after-tax purchasing power goes nowhere. But Frank found a way out. It didn't require moving to another state or giving up his CDs. It required 3 moves, each small, each fast, and together they reduced his $1,400 bill to almost nothing. The first move is a worksheet. The second is a phone call. The third is a single form that tells the IRS to take the tax out automatically so the bill never surprises you again. And the last move is the one almost every retiree skips because it feels too simple. Rebuild the ladder. Frank did not need a tax professional to fix his $1,400 bill. First, he pulled last year's return and ran the 3-line worksheet. Half his Social Security, every interest payment from every account, tax-exempt income. That gave him his combined income before the year ended, not after it. He could still act. Then he called his bank. He asked for a list of every certificate of deposit, every account, and every renewal date. That phone call showed him something the advertisements never mention. Several old certificates were about to renew at 3.8%. More important, he saw exactly which accounts were pushing him over the threshold, and by how much. Then he claimed the senior bonus deduction. For 2025 through 2028, taxpayers 65 and older get up to $6,000 extra off income, $12,000 for a married couple. Frank's accountant had never applied it. That deduction alone erased most of his taxable Social Security, but he still needed to stop next year's surprise. So he filed Form W-4V with the Social Security Administration. That form lets you withhold 7, 10, 12, or 22% from each monthly benefit payment. Frank chose 10%. The math was simple. Instead of a $1,400 bill every spring, he sees a small amount taken out monthly. No penalties, no scrambling, no shock. Finally, he rebuilt his CD ladder. Instead of one large certificate throwing all its interest into a single tax year, he split the $155,000 into smaller maturities. It was not about avoiding tax. It was about controlling when income hits the worksheet. A ladder allowed him to smooth interest below the cliff in some years and use the senior deduction in others. He kept the 4% yield. He just stopped feeding the tax torpedo all at once. By the end, his $1,400 bill was nearly nothing, not because he hid money from the IRS, because he stopped letting a 40-year-old formula decide when his benefits became taxable. Now, the final surprising detail most retirees never hear. Your bank already knows this rule exists. Your broker knows. The institution selling the CD knows the after-tax return can be far lower than the advertised 4%, but none of them are required to tell you. Their job ends at the deposit. The IRS job begins at the bill. The gap between those two is where retirees lose thousands every year. That gap is also where you can take back control. The worksheet exposes the number. The phone call reveals the renewals. The senior deduction buys time. The W-4V stops the surprise. The ladder stops the automatic tax increase. The same math that cost Frank in the opening can be reversed before the next tax year closes. The only question is whether you will run the 3 lines in time. The broader lesson from Frank is not about one tax bill. It is about who gets to decide how much of your Social Security the IRS can reach. Congress froze the numbers in 1983, and inflation has done the taxing ever since. Half of retirees now live inside that decision. The senior deduction may soften it through 2028, but when it expires, the frozen thresholds remain. Your only defense is knowing your combined income before the IRS does. If this video saved you from a $1,400 surprise, do one thing. Send it to someone who has a CD maturing this year. Then like the video, so the algorithm can warn the next retiree. Subscribe and turn on the bell, because next week we are opening another retirement trap that starts with a bank promotion. Banks call it free money. The IRS calls it taxable income. You can call it avoidable. I'll see you in the next one.